Why does spending exactly $500 to buy a tiny slice of a luxury asset feel like a shortcut to the elite investor class? You feel an instant psychological rush, believing you just unlocked institutional wealth diversification with a single tap on your sleek smartphone. But what happens when you urgently need that cash back tomorrow morning, only to realize your premium asset cannot be sold? The disturbing truth is that modern fractional platforms are engineered to lower the entry barriers while quietly locking your capital inside. When a market correction hits, that beautiful alternative investment portfolio transforms into a digital cage, completely isolated from any real secondary market liquidity. You own the asset on paper, yet you are trapped behind a systemic illusion, unable to extract your actual cash when it matters. How did fintech apps convince a whole generation that holding untradable crumbs of property is the same as building true wealth? To understand this wealth-freezing mechanism, we must pull back the shiny user interface and analyze the underlying liquidity risk premium. Traditional assets like index funds operate on massive global exchanges, where millions of buyers and sellers transact every single second. Fractional collectibles and micro-real estate platforms do not have that luxury, forcing users into a highly restricted, artificial ecosystem. Inside this closed loop, platform operators manipulate the bid-ask spread, ensuring they collect profits while you bear all the structural risks. Every time you purchase or attempt to liquidate a fraction of a commercial skyscraper, heavy entry and exit fees up to 5% are immediately extracted. These bidirectional friction costs silently erode the real performance of your investment, meaning the underlying asset must grow massively just for you to break even. Fintech marketing brilliantly exploits the psychological endowment effect, making you overvalue a fraction of a luxury item simply because you own it. Because the app makes ownership feel so immediate and intimate, you completely overlook the absolute lack of an active secondary order book. You see an estimated portfolio value on your home screen, but that number is nothing more than a superficial, illiquid illusion. When real-world economic pressure mounts, thousands of retail users rush toward the platform exit at the exact same moment. With zero external buyers willing to step into a niche app during a downturn, the internal secondary market freezes completely. Your hard-earned capital is effectively held hostage, locked inside an alternative asset class that has zero immediate cash value. The asset tokenization revolution promised to democratize high-value investing, but it omitted the brutal reality of the liquidity risk premium. Retail investors end up paying premium institutional prices for fragmented shares, while receiving none of the safety net protections of public markets. When fintech platforms obscure systemic risks with beautiful UI animations, upgrading your financial literacy is your only true shield. Subscribe to Economecha right now, and let's decode the hidden mechanics of modern wealth manipulation together. To expose exactly how much cash you are losing, we need to contrast this micro-investing illusion against traditional wealth-building vehicles. The structural comparison between liquid compounding returns and a frozen alternative portfolio reveals a massive financial tragedy that most users ignore. To expose exactly how much cash you lose on these niche platforms, we must contrast them against traditional wealth-building vehicles. A standard liquid index fund compounding steadily over 5 years requires zero management overhead, keeping your money fully accessible at all times. In stark contrast, an initial $10,000 allocated to alternative fractional shares immediately faces aggressive structural dilution from the very first day. The platform instantly extracts a heavy 3.5% acquisition fee right at the start, meaning your capital enters the market heavily handicapped. As time passes, a recurring 1% annual storage and insurance fee continuously chips away at your remaining principal balance year after year. When you urgently try to liquidate your holding during a market downturn, a sudden 20% haircut is forced upon your sell order. Because there is zero buyer demand in the closed app ecosystem, you must accept a massive loss just to claw your cash back. While the traditional liquid asset grows smoothly, your fractional alternative investment has been systematically hollowed out by invisible platform mechanisms. The convenience of buying digital crumbs of luxury items blinds retail investors to the massive capital erosion taking place behind the screen. These specialized micro-investing apps operate more like predatory digital casinos, structuring the rules so the house always collects its premium. Your paper wealth might look impressive on a colorful dashboard, but it remains frozen capital that cannot serve your real-world needs. Real diversification should provide a financial safety net during crises, not completely lock your money away when you need it most. When the bidirectional transaction friction outpaces the organic appreciation of the underlying alternative asset, the retail investor always loses the game. The entire business model of fractional tokenization relies on exploiting the retail crowd's cognitive errors regarding asset accessibility. They open the front door wide with gamified user interfaces, but they lock the back door with an illiquid secondary order book. To break free from this systemic illusion, you must immediately implement the scientific Liquidity-First Default Rule in your portfolio. Before allocating a single dollar to any alternative digital platform, verify the presence of an open, completely independent public exchange. You must mathematically calculate the total bidirectional friction cost to ensure fees will not swallow your projected investment compounding returns. When you open your digital asset applications tomorrow morning, audit the exact bid-ask volume on your current fractional holdings. Establish an automated, unbreakable rule that strictly limits speculative, illiquid alternative assets to less than 5% of your total net worth. By anchoring your capital in high-liquidity environments, you ensure that your wealth remains fully weaponized for real-world economic opportunities. Stop letting beautiful user interface animations and false promises of elite diversification dictate how you manage your hard-earned cash. True financial freedom is built on capital mobility and absolute control over your liquidity, not on holding digitized fragments of luxury sneakers. Deprogram your mind from the illusions of consumer capitalism and take command of the hidden mechanisms shaping modern wealth. The system wants your wealth frozen, but with the right financial literacy, you can keep your capital moving forward permanently.